Now, should you be worried that every stock market analyst you meet is bullish? That's a question that Tom Elliot, International Investment Strategist at deVere Group, joins us now, and potentially you can answer that question for us, Tom. Should we be worried?
Well, it's a funny question to be asking after what we've seen in recent weeks. I actually prepared my presentation in early January for my trip to South Africa, and it's difficult to imagine to go back then, but in early January the consensus seemed to be that it was going to be another good year for stock markets, not as good as last year, but a good year, and treasuries and core fixed income bonds would fall. That was sort of consensus, and there was a lot of shorting of treasuries going on in early January. We forget that. After what we saw in January, well, markets fell, and well, guess what happened to the 10-year treasury? We actually saw that rise in the yield shrink. So in a way, that question, it seems out of date, but I was asking it for a number of reasons. I was very conscious, I think we all are, that perhaps US equities look a bit overvalued. Perhaps we're nervous about the future of US earnings. As a percentage of GDP, profits are at record high. Can that continue? There's been a low-level investment in the US by companies. We're sitting on huge amounts of cash. So I was really questioning that. At the back of my mind, I was also questioning the emerging markets. Were they looking for something? What I wasn't expecting was to see that problem with emerging markets emerge in January and create the havoc it did.
So interesting. I've just come back from Davos for the 10th trip, and I can tell you the last 5 years the mood was pretty gloomy. This year, very upbeat. Americans extremely confident. Fracking has made a massive difference to their economy. They're excited about themselves. The Europeans, Draghi was kind of upbeat, saying that the problem 4 are not such a problem anymore. The Indians are saying after their election they're going to be growing at 8% from 5% at the moment. So the economic picture we're getting from the world seems to be positive, and yet the markets in January, as you say, were going the other direction. Are we disconnecting somewhere?
No, I mean, drowned out in all the news about emerging markets was the announcement from the IMF 10 days ago of upgrading global growth from 3.6 to 3.7% growth this year. And I very much believe that if you look at the broad macro picture, it is telling you to at least remain invested in risk assets such as equities. Certainly don't sell into the current downturn. I think markets may weaken over the next couple of weeks, especially emerging markets, especially emerging market currencies. But I'd be loath to be bailing out now. And if anything, I'd be looking to be picking up, I was going to say picking up pieces, that sounds a bit gruesome, but to be looking to expand my my exposure to risk, especially emerging markets, in a few months' time, because of those positive macros, fundamentals that you've just mentioned.
Tom, we feel that the story that hasn't been asked, the question that isn't being addressed, the elephant in the room, is what happens, what's the end game of quantitative easing? Clearly at the moment, create money, money's going to go into assets. But where does it all end?
It all ends when we get back to the long-term standard real US interest rate, which is around 3% in real terms. Now, we've got, we're nowhere near that. We've got real interest rates in the US probably about 1.5. So how do we get to that? Well, it's got to be a rise in nominal interest rates. And we are going to see that happen. Absolutely no doubt about it. But it's going to take time. And it's going to take time because of all those problems I just mentioned in the US of companies not investing. Don't forget, despite the fact we've got a fall in unemployment, we've got almost record low levels of labour participation going on in the US. So the normalisation of interest rates, so we get back to long-term real rate, is going to take some time to happen. And
but so what happens to all the debt that's being created?
On the government side,
what happens to all the debt that's being created?
Well, allow me, on the government side, it's going to disappear because a bit of real growth, a bit of inflation, nominal. If you can get nominal at 4% for 10 years, well, all your outstanding debt shrinks in real terms by 10%.
Nominal inflation at 4%.
If you can get growth, say, of 3%, inflation of 1.5%, so you then have nominal growth of 4.5%, and you can have that running for 10 years, just for my model, then the real value of your outstanding debt shrinks by 45% of outstanding government debt. So I think that in terms of American government debt, they're rather hoping that just good levels, decent levels of nominal GDP growth will shrink that. Now, when it comes to private sector debt, then you've really got to be looking for real wage growth to shrink it and to enable to pay it
off. So you don't seem to be alarmed like some of the gold bulls are. They think that there's going to be hyperinflation, or at least the risk of it.
Gold bulls are talking up. Gold bulls, I mean, I said it, that was a Freudian slip. They're talking up their own book. No, the lovely thing about inflation, moderate growth, moderate inflation, is it whittles away debt. How did Britain pay off all its debt after the Second World War? It wasn't by honestly working hard and paying it off. No, we had inflation. It did the job for us. It'll do the same for everybody. And then, in a way, where I am, one of the areas where I really am concerned is deflation in the Eurozone, because obviously you have deflation, it does the opposite. It actually magnifies the real impact of the debt burden on those peripheral countries.
But then the bigger question is, where does this leave emerging economies, as you mentioned, are in crisis at the moment?
Emerging economies, just as the UK did throughout the 60s and 70s and 80s, you go through a period of strong growth, which they did thanks to quantitative easing over 2008, 2011, import more than export. They ran into a current account problem. Foreigners eventually say, oh, hang on, stuff this, forget marbles, we're going to demand higher and higher interest rates to make up for the fact that you don't seem to be able to stop importing. First of all, the currency takes, well, first of all, interest rates rise and the currency takes a strain, and then everything gives way and the currency collapses. And that is unfortunate. I think we've probably got more currency losses throughout the emerging world as that pans itself out.
Tom, what do you advise? And really, just to give people a little bit of background, deVere is a big operation, 400 consultants, 70 offices around the world. And you've recently been appointed there in October last year. What are you advising in the portfolio split, given that you say equities will probably outperform fixed interest? For
a long-term investor, which most of our clients, on a 60-40 traditional model portfolio, 60% equities, 40% bonds, overweight equities, underweight bonds, within bonds, underweight treasuries. I know that's difficult when you've just seen a little rally in January, but the tapering of QE is going to lead to a normalization of interest rates, and that means treasuries are going to weaken.
And within equities, what's the split there?
Within equities, slightly overweight, more or less neutral, but certainly neutral the US. Slightly overweight the Eurozone and Japan. I believe the Americans have got this phrase, escape velocity. The Eurozone and Japanese economies have not yet reached escape velocity. They are, share prices still look attractive. When they do reach that period of self-sustaining growth, when they reach escape velocity, I think you're going to have a lot of interest from global investors, particularly American ones, who are further along the economic cycle. They want to get into areas at early stage in the economic cycle. And so I do think there's still value in the Eurozone and Japan. And
bring it down to the level of a private investor, would this be through ETFs, index trackers and so on?
Well, I personally do like, I'm not talking about synthetic ETFs, I'm talking about plain ETFs that are actually backed with stuff. Those are a low-cost option. But actually, there is so much available that's out there. There are some active fund managers who do deliver value. I know it's very easy to be cynical about active funds, but there are some. My own preference is actually for the more passive, just because the fees are lower. But I don't want to appear dyed in the wool over that.
But there's no particular stocks that are standing out for you?
Do you know, I don't actually go down into the individual stocks, but were I to be tempted there, I would be looking to the ones that have really bombed out, the developed market stocks that benefit from developed market accounting rules and everything like that, but with large amounts of profit growth from emerging markets which have taken a real hammering. And I'm not allowed, I don't want to talk about individual stock names, but household products, household food groups that are international with fast growth in the emerging markets that have taken a hammering, that can offer you a good yield. Well, Unilever, Nestle, those sorts, those are the ones.
You weren't going to mention the individual names, but we do appreciate that you did. You broke down. Thanks, Tom.